Welcome to the Businesstalk, a global podcast series that highlights distinguished faculty members and their impactful scholarly contributions. I am Deepak, your host from India. We are honored to welcome Dr. Christian Borch as our distinguished guest on today's episode. Before we get started, I would like to introduce today's guest. Dr. Christian Borch is a professor of sociology at the University of Copenhagen, where he also serves as a deputy head of Department for Research. A graduate of Aarhus University and University of Copenhagen, Dr. Borch has held academic positions at Copenhagen Business School, the New School for Social Research in New York, and Goldsmith University of London, a career trajectory that reflects both his intellectual range and his global scholarly reach. Professor Borch's research straddles an unusually wide intellectual terrain, from crowd theory and urban sociology to the sociology of finance and the governance of machine learning in financial markets. His award-winning book, The Politics of Crowd, an Alternative History of Sociology, earned him the American Sociological Association's Best Book Award and a higher doctorate from the University of Copenhagen. His 2020 monograph, Social Avalanche, Crowd, Cities and Financial Markets, published by Cambridge University Press, extended his intellectual lineage into the domain of financial market dynamics. Over the past decade, Dr. Borch has focused extensively on the sociology of algorithmic and machine learning driven finance. A sole principal investigator on two major grants, a Sapere Award grant from the Danish Council for Independent Research and a prestigious consolidator grant from the European Research Council, Euro 1.59 million. He conducted in-depth qualitative fieldwork, interviewing traders, regulators, and developers across the financial capital of London, New York, and Chicago. In collaboration with computer scientists, he also developed agent-based simulation to model algorithmic interactions in financial markets, work supported by a grant from William Foundation. He is also the co-editor of the Oxford Handbook of the Sociology of Machine Learning, published by Oxford University Press in 2025, cementing his position as a leading voice on the social dimensions of artificial intelligence. Beyond his own research, Dr. Borch has been a prolific contributor to the academic community, co-founding and serving both nearly 2 decades as an editor-in-chief of Distinction Journal of Social Theory, supervising 5 doctoral researchers, and serving as a reviewer for the European Research Council, the British Academy, and the Swiss National Science Foundation, among others. He has presented his work at Oxford, Yale, UC Berkeley, and the New School for Social Research, and has briefed major financial institutions and regulators including the Bank of England and the US Commodity Futures Trading Commission. In today's episode, Dr. Christian Borch joins us to discuss his book, Trading Beyond Understanding, Machine Learning, Risk and Markets. Drawing on over a decade of fieldwork, he explores how machine learning is reshaping financial markets, shifting trading from human expertise to autonomous self-learning systems. Let's not keep you waiting. Please join me in welcoming Dr. Christian Borch to the conversation. Professor Christian, it's a distinct privilege to welcome you to Business Talk. We are grateful to you for accepting our invitation.
I'm very pleased to be on the show.
Thank you. Professor, you used the term trading automatons to describe today's ML-driven trading systems. For our listeners who may not be familiar with financial markets, how would you explain in simple terms what a trading automation is and why it's fundamentally different from a traditional algorithmic trading system?
Yeah, so thanks for the question. So I'd like to perhaps begin with a bit of historical outline before I explain what a trading automaton is. So I guess many of the people who follow your podcast would be familiar with old images of financial markets where we have stock exchanges with a lot of human traders standing on trading floors, yelling, pushing, screaming to get their orders across. Now, financial markets today do not really consist of these physical trading floors. What happened a couple of decades ago is that trading was increasingly automated, meaning that people would set up computer systems, fully automated computer systems that would then trade automatically in markets. Now, what I do in the book is to distinguish that form of old automated trading with a new form of automated trading, machine learning based automated trading. I refer to these two types of trading as the first generation of automated trading and second generation of automated trading. So in the first generation of automated trading, you would have a group of human individuals would come up with an idea for a trading strategy, and then they would basically encode that strategy into their software and hardware systems. Now, with machine learning systems, the idea is somewhat different. You'd still have fully automated computer systems, but instead of having human individuals coming up with the idea for the trading strategy, you would feed the computer system a lot of data, financial data, and then the idea is that the machine itself generates a trading strategy. And I refer to that kind of second generation systems as trading automatons. And that's a notion going back to ancient Greek, basically, where the automaton, refers to a self-moving identity or entity, a self-moving entity. And my basic claim in the book is that what we are seeing nowadays is that financial markets, or automated trading at least, is moving in this direction, increasingly toward trading automatons, fully automated systems that are executing strategies in the markets that they have themselves produced.
Professor, you spent over a decade conducting fieldwork, interviewing traders, developers, and regulators across London, New York, and Chicago. What was the most surprising or counterintuitive thing you discovered on the ground that you couldn't have learned from just reading research papers?
Yeah, so it is true that this research is based on probably around a decade of research where we did, not only me, but a group in two research projects. We were a large group of researchers doing more than 200 interviews with the people who are essentially developing these types of algorithmic systems. So traders, software developers, as you mentioned, regulators, stock exchange officials, etc. What we learned, I think, is partly that setting up these types of systems is exceptionally complex. So it might be that on the face of it, it would appear fairly simple, hire some machine and expert, ask that person to develop a trading system. But doing that is just incredibly difficult. So there are all sorts of complexities, mundane complexities also in terms of cleaning the data that you need for these kinds of systems to operate. Having proper simulation systems in place that mimic how stock exchanges function. So all sorts of practical issues that are extremely important for these systems to really function. And that surprised me, the complexity of these mundane aspects. Another thing that surprised me was that a lot of the people who are developing these systems, they entertain a very close relationship with their computer systems. So many of them would give their software systems various types of names. They would basically treat them as if they were human individuals. So they are trying to maintain a kind of social relationship with their software systems. That surprised me a bit as well.
Professor, one of the striking arguments in your book is that these machine learning systems become opaque, even to the people who build them. How do trading firms actually manage systems they don't fully understand? And does that opacity concern them as much as it concerns you?
Mhm. Yeah. Yes, opacity is really a key issue, especially for those types of machine learning systems that are based on deep learning, machine learning architectures. Now, it's not only a concern to me, this opacity of deep learning systems is not only a concern to me. This was a concern that was widely articulated in the firms where we did interviews. And the reason for this is quite obvious. If you have a fully automated trading system that is trading in the market, but you don't quite know what it's actually doing or why it's acting as it does, then the risk of losing money is quite significant. So it could be that your system is good at earning tiny profits in the short run, but would lose a lot of money in the longer run. And if you're not able to decompose the system and really tease out why it's acting as it does, then that type of risk is quite significant. So this concern with opacity was one that was widely expressed in the industry. And then in terms of how firms are dealing with that, yeah, that's actually one of the reasons why people are maintaining a kind of social relationship with their machines. So in one of the firms where we did interviews, this is a firm that plays quite a significant role in my book. The human individuals would really treat the system as if it were a human being, and they would try to engage with the system and have a kind of interaction with the system in order to tease out its intentions, as it were. So they would deploy various um, software techniques in order to have a sense of why the machine was trading as it was. But they would also really try to have a kind of conversation, if you like, with the machine in order to better understand why it's trading as it is.
Professor, earlier research introduced the concept of knowledge risk in automated trading. How does this evolve in machine learning era? When a machine generates its own trading strategies, who is really responsible if something goes wrong?
Yeah, so the notion of knowledge risk, which I draw from other researchers, essentially says that well, there might be a risk at stake if certain types of knowledge are deployed, or if certain types of knowledge are not deployed. In terms of fully automated trading systems, and especially those that are based on machine learning, knowledge risk is really related to, for instance, data. So the people would often talk about machine learning not being better than the data on which it's trained, garbage in, garbage out, these kinds of reflections. That is certainly the case. And this is also the reason why, as I explained earlier, that trading firms would spend a lot of energy on trying to really have proper data. They would spend hours and hours on cleaning their data so as to avoid any mishaps in the data that is being fed into the machine. So that's certainly one dimension of knowledge risk. Another one is, and I alluded to that earlier also, that the trading firms would also try to set up simulation environments. So they would create essentially an imitation of the machines that are hosted by stock exchanges. So they would essentially create their own artificial stock exchange. And in the training of the computer systems, they would rely on that simulation as being really, similar to how the actual stock exchange is functioning. If there are any divergences between how your simulation works and compared to how the stock exchange actually works, then you might have proper data, good data, but the training exercise could also be off.
Professor, you argue that machine learning trading systems possess a genuine form of agency, not human agency, but machine agency. This is a bold sociological claim. How do you respond to critics who say machines are simply executing human intent, just faster and at a scale?
Yeah. So this is an argument that is really core to the book. And this is where I distinguish, as I said, between first generation automated trading systems and second generation automated trading systems. When we're talking about first generation automated trading system, there are certainly these machines would be an extension of human intention. So there would be human traders who would come up with a trading idea, an idea for a trading strategy, and that idea would be coded in the machine. So he would have essentially a kind of direct extension of human intellectual capacity, if you like. With second generation automated systems, those trained on machine learning techniques, here the entire idea is that the machine is actually better than human beings at detecting signals in markets. So the entire motivation for doing that kind of automated trading is that the machine is able to come up or identify some patterns that human beings wouldn't be able to. But in the process of creating that kind of trading automaton, some kind of delegation or the delegation is extended so far that we can no longer talk about human intent being encoded into the machine. So these machines are indeed designed to make or to come up with their own trading strategies. So it is certainly agency, and it is agency that is proper machine agency in the sense that human individuals obviously designed the overall architecture, human individuals decided on which data to feed the machine. But given those kinds of parameters and this kind of curation, if you like, the machine is supposed to come up with its own trading strategies. And this is what makes it really autonomous, or at least semi-independent in terms of actual trading.
Professor Work introduces the concept of collective machine behavior, ML systems interacting with other ML systems in market. What does this kind of machine-to-machine interaction look like in practice? And what systemic risk does it create that regulators may not yet for prepared?
Yeah. This is another point that's quite important to me in the book, that's if we take seriously how automated trading systems are developed and deployed in financial markets today, then that also necessitates a discussion about machine interaction. So it's no longer human individuals who are interacting with one another in markets, it's actually machines that are interacting with one another in markets. And to be more specific, I mean, if two people are meeting on the street, then they would be interacting face to face. That's not the type of interaction we're talking about in financial markets. Just like the conversation that we are having now, which is mediated by a platform, right? This is basically the same that we see in financial markets. What is mediating different trading systems would be the stock exchanges then. And so machines are interacting via trading platforms, and they're doing that anonymously. So trading systems are sending orders to the markets, buy or sell orders, and they don't know who the other side is. They don't know who the other parties are who are also sending orders to markets. Now, with this machine interaction comes all sorts of potential emergent effects that are really unplanned and could be fairly catastrophic in markets. So there's a lot of discussion about so-called flash crashes, where machines are interacting in markets, producing unforeseen events that make markets really crash. There was a big event in 2010, the so-called big flash crash in the US, where tons of money were lost in just a couple of minutes. And what is really interesting here is that these kinds of unforeseen interaction effects can take place even if machines are designed to actually be acting in a responsible manner in markets. So paradoxically, even if machines are designed to be acting fairly and properly, even in those situations, these kinds of interaction effects might occur. So that's one dimension of machine-machine interaction. What is then interesting in terms of machine learning-based systems or trading automatons is that to the extent that they are also trained on the same or similar types of data, then it might be an issue that they over time would develop more or less homogeneous types of strategies, and this would also increase potential cascade effects in markets if independent trading systems, basically respond in an identical manner to the same signals in markets.
Professor, machines are now generating their own strategies and learning independently. What is the role of the human trader or developer today? Are we moving toward a future where human judgment becomes entirely peripheral in financial markets?
Well, I wouldn't say that humans and human judgment would necessarily be entirely peripheral, but I would certainly say that humans are being moved toward the periphery. Obviously, there are many individuals who act in markets as retail traders or retail investors. So these kinds of human investors obviously do exist, and obviously there are human individuals employed in banks and hedge funds, etc. But I would say that increasingly the real action and interaction taking place in markets is a form of action and interaction among fully automated trading systems. So yes, humans are moved toward the periphery. Yeah.
Professor, you have briefed institutions like the Bank of England and the US Commodity Futures Trading Commission. What did those conversations reveal about the gap between how fast these technologies are evolving and how prepared our regulatory frameworks actually are?
Yeah, that's interesting. So I think a starting point for this is to stress what regulators know and what they don't know. So the kind of information regulators have access to would certainly be so-called order book data. So all orders sent to the markets, all messages sent to the market, regulators have access to that data. And as a researcher, this is also a type of data I would, love to get access to, but it's very hard to access as a researcher. Anyways, in this sense, you can say that regulators have access to all orders coming in. They would have a complete sense of everything taking place in the market. What they don't have access to would be the individuals who are developing these types of systems. And I recall when we presented our work at the CFTC in Washington, we had over lunch we had a discussion with one of the regulators, and I mean this is anecdotal, but nonetheless, he made the interesting remark that, well, perhaps someday we should actually have a chat with the people we regulate. And that's precisely what we are doing. We are having, we are observing, we are trying to get a sense of those trading firms that the regulators are regulating. What are the thoughts being expressed in these trading firms? What are the concerns being expressed in these trading firms? This is where our focus has been. So I think we can supply regulators with a better idea of how trading firms are actually thinking about markets and how they are trying to develop systems in the markets. Another thing that's probably important to stress is that regulators, or the kinds of regulation that are currently in place, at least in Europe and in the US, is kind of lagging behind technological developments. So there's certainly regulation in place, but it's giving trading firms quite a bit of leeway in terms of interpreting the rules that exist. So with the current regulatory frameworks that we have in place, we can't really be sure that trading firms are properly monitoring their systems, for instance, even though they're supposed to do that. So that's definitely a core issue amongst or for regulators. And then just one final point. When I talked to the Bank of England, their particular concern was that and that goes back to the point made earlier, that perhaps machine learning based systems, they might, if they're trained on the same data, then they might eventually converge on the same trading strategies, even if this was not intended by the human designers. And that kind of model convergence was actually quite a bit of a concern to regulators in the UK, at least. Also because it's very difficult from a regulatory point of view to actually address the kinds of issues that might emerge from that.
Professor, Trading Beyond Understanding is ultimately a sociology book, not a finance book. What do you want sociologists, policymakers, and everyday citizens to take away about what happens to society when machine action, not human judgment, sits at the center of our economic systems?
Yeah, good question. So what I would like people to appreciate is, first of all, that machine action is actually the main form of action in financial markets. So we need to take that really seriously, I think. And one dimension relating to that is that, as we talked about already, that when machines are at the center of financial markets, then we also need to discuss machine-machine interaction. This opens up just a complete new array of questions, not only for regulators, but also actually for sociologists, how to think of action and interaction when it's not involving humans directly. So there are all sorts of very interesting and difficult questions that arise from the appreciation that now at the center of financial markets are machines that are fully automated and semi-independent.
Professor Borch, I would like to conclude this episode with one last question. The title of your book, Trading Beyond Understanding, suggests we may be entering territory where even our best tools for comprehension fall short. Is that a warning or simply a new reality we need to learn to live with?
Mhm. Yeah, I think it's both. Honestly, it's a warning, and it's again an appreciation of the reality that we're living in, and I might add that what I find fascinating about financial markets is that this is a domain in society where new technologies are quickly picked up upon. So, I mean, that's not only machine learning techniques or AI. Throughout the modern history, financial markets have been very quick at focusing on new or adopting new types of technologies because you might gain an edge from doing so over your competitors. I would claim that a lot of what we are seeing in financial markets nowadays, in terms of these fully automated trading systems and these semi-independent trading automatons interacting with one another, this is basically a test bed, if you like, of developments that we are going to see in other societal domains. Think of automated warfare, for instance. That would be another domain where we have fully automated systems interacting with one another. And there might be all sorts of other domains. There's a lot of discussion at the moment about agentic AI. That also suggests that we are moving now toward a situation where fully automated systems are making decisions on their own, essentially. What I hope readers would gain from the book would be insights into how these types of systems are developed and the kinds of questions that they do raise.
Professor Borch, this has been a truly eye-opening conversation. The idea that machines are now making decisions that even their creators don't fully understand is both fascinating and thought-provoking. Thank you for bringing such clarity and depth to a subject that will not only grow more important in the years coming. For our listeners, do explore Trading Beyond Understanding. It's a book that challenges how we think about markets, technology, and the future of human decision making. Until next time, keep questioning and keep learning. Professor Christian Borch, thank you for joining us. It has been a truly genial pleasure engaging with you and exploring these insights. Thank you so much.
Thank you. My pleasure.